Okay, check it out. Whenever you're entering a trade in the Forex market, let's just say you're entering a trade on Euro USD and you're entering a one lot trade looking for a buy, you'll notice that whenever you open the trade, it's always going to start in a negative. And this is because of what's called the spread. Now, for a lot of beginner traders, this concept is a little bit difficult to understand. And even for some traders that have been trading for a while, they still might not fully grasp this concept. But in today's video, I'm going to explain every single thing you need to know about the spread. And I'm going to explain it in a way where it's super easy for you guys to understand. And throughout the video, I'm going to explain to you why this spread even exists and how you'll use this spread to enter your trades. And I'm going to be able to show you how you can actually save some money on the spread so you don't get hit with as big as spread as probably other traders. So this way you'll save yourself some money in the long run and you won't have as big of a spread. So before you take another trade, make sure that you fully understand this. So grab a pen, paper, take some notes, and let's get started with the video. So whenever you're looking at a currency pair, whenever you're looking at your quotes window, you'll notice that there's always going to be a number on the left and there's always going to be a number on the right. Now, the difference, the gap between the number on the left and the number on the right, that is how big the spread is. Now, what is the spread? The spread is how brokers and liquidity providers make their money. So they make money based off spread and commission. So in terms of spread, let me just kind of explain to you how they're going to be able to make money. So what these brokers are doing, the brokers are getting their prices. Let's just say, for example, Euro USD. I'm going to take a screenshot here just so I can have the numbers stop moving to give you this example. But let's say the broker is, let's say we're looking at Euro USD and the number on the left you see is ends in 57 and the number on the right ends in 59. So you can consider the price for Euro USD is 1.2158, pretty much right in the middle. So that's the price where the brokers are getting this quote from. However, you as a client to the broker or even the liquidity providers are going to mark up the price. So they're going to sell it to you at a markup. So you, if you're wanting to buy Euro USD, you're going to have to buy it at the price on the right, at the higher price. Because think about it, if they're getting it at 1.2158 and they're selling it to you at 1.2159, they're pretty much marked it up by a very small, less than even a cent, right? This is like 1 pip. Now, think about it. If you're ending up having to buy the currency pair at 59, and let's just say hypothetically that you accidentally bought Euro USD and you wanted to exit right away. You're like, oh shoot, maybe I shouldn't have entered that trade. And let's just say you want to exit right away. Well, guess what? The price that you're going to be forced to exit at is going to be the price on the left, is going to be at the price at the 57. So my question to you is, if you bought it at 1.2159 and you sold it at 1.2157, have you made money or have you lost money? In this case, you've lost money. Does that make sense? So just know the number on the right is always going to be what's called the buy price, or in other words, the ask price. The number on the left is always going to be the sell price, at whatever price that you're going to sell it at, or in other words, the bid price. So for the liquidity providers, they're getting it at the rate that's directly in the middle, but they're selling it to you at a markup so the liquidity providers can do their normal operating businesses, and brokers that charge you spread-based commission, they're getting it at a lower rate, and they're just charging you a spread-based difference for a commission in order for you to enter that trade. Now, going back to the actual MetaTrader 4, the thing that you need to understand, and let me explain this in another perspective, looking at it on the actual chart. So looking at it on the actual chart, if you just hit open chart, you'll notice the top line. Let me just go into the closer time frame. Let's do like the 1 hour time frame so you can see the two numbers even better. So the top line, the red line, that's always going to be the ask price, or in other words, the buy price. And the number on the bottom, the blue one, that one's always going to be the bid price, or in other words, the sell price. And by the way, if you only see one line, you're going to have to go to your settings and you're going to have to scroll down and find where it says ask price line, and you need to go ahead and enable the ask price line. Once you have that enabled, it's going to allow you to see both of the lines. So what you need to understand is whenever you input a buy, it's always going to enter you at the top line. And in order for you to actually get into the profit, in order for you to leave the negatives, to get out of the red, that blue line must slowly creep up to the exact point where you entered, or in other words, that red line. So let me just do another example. I'm going to hit buy. It's going to enter me at that red line where it says 58 right now, where it says 1.2158.3. I'm going to hit buy, and it's going to input me right there at that red line. And it's going to stay in the negative. It's going to stay in the negative until that blue line creeps all the way up to the point where I actually bought it up. And these two lines, the red line and the blue line, they always move in tandem. They always move together. They always move in unison. Now, as traders, we would want to trade at a time when the spread is as small as it possibly can. So it just makes sense that we don't want to trade whenever the spread is wide. Why? Because if it's wide, if the blue line is way below the red line, then the price has to go a lot higher for just you to even just get out of the negative, which is why it's optimal to trade at times when the spread is smaller rather than bigger, when the difference between the bid and the ask is small. So let me just kind of go back to the actual chart area here, or the actual quotes window, and let me kind of explain it in another way. The number on the left, looking at Euro USD, says 55. The number on the right says 57. The apps, the MetaTrader 4, tells you what the spread is. So the way that you're able to determine how wide the spread is, how big the spread is, you're able to essentially subtract the number on the right from the number on the left and kind of see what the difference is. So let me just kind of take a screenshot so those numbers stop moving. And you'll notice the difference between the number on the right, which is 57, comparing that to the number on the left, which is 55. You'll notice the difference is 2, right? The difference is 2 pips, or in other words, 2.0 pips. The small little 7 on the top right corner of both of the numbers, that's what's called the pipette. So the difference between this currency pair is a 2 pip spread. And that even tells you on the actual line itself where it says spread 20, that tells you the spread is 2.0 pips. Now, let's just say we look at the next one. We see the difference is 42 versus 39.7. The difference, or in other words, the spread in this case is 2.3 pips. And you do the math for a USD JPY, you notice the spread is 2.3 pips again. And one thing you might have noticed by looking at this page here is any currency pair, this is pretty important, any currency pair that includes the US dollar, just by literally looking at this, currency pairs that include the US dollar usually have a smaller spread than currencies that do not include the US dollar. Looking at NZD USD, that currency pair has a spread of 3.2 pips. However, the last three, notice these don't have USD in them. Australian dollar versus the New Zealand dollar, the spread for this one is 7.5 pips. And for GJ, in other words, GBP, JPY, the Great Britain pound versus the Japanese yen, this one is 5.9 pips. And the bottom one here, GBP CHF, this one is 7.1 pips. So just be aware, whenever you're trading a currency pair, hey, that rhymed. I'm a poet and I didn't even realize it. So whenever you're trading a currency pair that doesn't have a USD, or in other words, is not a major, whenever you're trading a currency pair that are either minors or exotic currency pairs, their spreads are going to be wider than spreads with major currency pairs. Or in other words, majors are the currency pairs that include a US dollar. So now going back and looking at our actual trade that we had just entered right now, we're currently in $21 loss because the spread, the price still needs to move up to a point where the blue line reaches the point of our entry. So now if we decided to sell right here, because remember we initially bought, and to close a trade we need to sell it. You buy first and then you sell, right? If we were going to sell it right now and close our trade, we're going to end up having to sell it on that blue line, which is around the 55 mark, the 1.2155. So if you sell it right now, you'll notice it'll say close with a loss of $26, and we're going to close at the loss of 26 bucks. And the fact that we were trading the currency pair Euro USD and this was a one lot trade, that means we either make $10 per pip or we lose $10 per pip. In this case, the spread, the point that we closed the trade, we lost the trade at 2.6 pips, which is why we lost 26 bucks. So now in the case that we wanted to enter a sell, let's say we were aiming that the market was going to go down, we enter a sell, is going to enter us on that bottom line, which is the 5.5, and we're going to automatically be entered into the trade. And in order for us to actually see profits, that top line, that red line must go down all the way to where we entered the trade, which was at that blue line. Now, super, super important thing to understand, depending on wherever you live in your time zone, you need to understand whenever the US session closes. So if you're on the East Coast, this is 5 o'clock. If you're on the Pacific Coast, this is going to be 2 p.m. So 5 p.m. Eastern, 2 p.m. Pacific, or if you live Central Time Zone, that's going to be 4 p.m. Central. So wherever you live in the world, understand whenever the U.S. session closes, no matter where you live in the world, whenever the U.S. session finishes, the spreads, based on your broker, the spreads will dramatically widen right at 5 o'clock Eastern. So at 5 o'clock Eastern, the spreads will dramatically widen. And it is that at that point where it is not wise, it is not smart to enter trades during that period simply because the spread is wider. Meaning if you're looking for a buy, you're going to be entered at the red line. And if the red line, the difference between the red and the blue is just wide, you're going to have to wait until that blue line creeps all the way up to where the red line was. And if that gap is huge, then you're going to have to wait a lot of pips for the price to actually get you to even break even. So you can get an idea of what the average spread is just by looking at the numbers that you see on MetaTrader 4. You'll notice that Euro USD usually has a spread of maybe 1 pip, 2 pip, sometimes even less than 1 pip. And then looking at GBP JPY, that could have a spread of maybe 3, 4, 5, 6 pips, maybe even 7 pips. You'll get an understanding of what the average spread is based on whatever currency pair that you're trading, and you'll realize at 5 p.m. Eastern, you'll see how dramatically wide these spreads do end up becoming. And at that point, you might not want to consider entering a trade at that point until maybe wait an hour or so until the spreads do finally start tightening back up again. So it's like an unwritten rule in the Forex world that we kind of don't trade at 5 o'clock, 6 o'clock p.m. Eastern simply because there's not enough liquidity at that time. There's a lot of low liquidity, which causes the spread to widen and allow you to not get as optimal of an entry as you could have had the spread been smaller. Now, one last tip I want to give you. If you are working with a broker that does charge you a spread-based pricing model, let's say a market maker-based broker versus an ECN broker charges you commission, so they give you the best possible spread that they're able to get, so you really don't have to worry about what I'm about to tell you. But for the people who are trading with a market maker-based broker where they do charge you just based on spread, look for an option where they have either a commission-based pricing model as well. Go to the website, chat on their little chat window, and then ask if they have a commission-based pricing, because what that does is that'll allow you to get quotes that have smaller spreads, and they'll just charge you commission on the difference because they're giving you a smaller spread. So at the end of the day, you're paying the same amount of fee, but the beautiful part is the spread does get smaller for you. And having that smaller spread is the most optimal way to enter trades in the Forex market, especially if you're using buy limits or sell limits. And I talked about buy limits and sell limits in one of my previous videos, so I'll just link it right up here if you want to watch that as well. Okay, so the main key takeaways for this video is number one, the spread is the difference between the number on the right and the number on the left, which is the ask versus the bid, which that gap is called the spread. And the spread is created simply because that's how brokers make money, and that's how liquidity providers make their money as well. They essentially are charging you like a small little markup for you to enter that trade. Now, you have to understand whenever you're looking to buy, whenever you buy, you're always going to be buying on the number on the right, on the more expensive price. And whenever you sell, you're always going to be selling it on the lower price, the number on the left, or in other words, the line that's going to be on the bottom. So you always buy on the number on the top, you always sell on the number on the bottom. So for example, if I wanted to close my current trade, which was the sell that I had entered, if I want to close this current trade right now, I'm going to have to buy back what I sold, right? I'm shorting it, so I have to buy it back to kind of close the trade, and they're going to force me to buy at that top red line. So I'm going to have to buy it back at that top red line, which is going to allow me to lose right now, in this case, $17. Now, the next thing you have to understand is it is at a time at 5 p.m. Eastern, or depending on wherever you live in the world, the spreads will widen, and you probably do not want to trade at that time. And the spreads are also sometimes wide when the markets open up on Sunday evening, and the spreads sometimes get wide before the market closes on Friday. So just be aware of the spread, and you're able to see what the spread is simply by looking at the numbers on the left. It says 18 for Euro USD. That's considered 1.8 pips. And the last key takeaway of this video is if your broker does charge you spread-based pricing, check to see if they have any commission-based options as well, because that's going to reduce the spread. They're going to charge you a bit of commission. At the end of the day, the fee for you is going to end up being pretty much the same anyways, just as spreads get smaller for you, which is beneficial in the long term whenever you're looking to get what's called sniper entries using buy limits and sell limits. So hope this video was useful for you. Hope you guys understand now what exactly spread is. And if this video was useful, I would appreciate it if you left a like on the video and go ahead and comment down below if it was useful. Other than that, that is all for today's video, and I'll catch you guys in the next one. Take care, guys.